Breaking news. Circle just crashed 22%. Coinbase dropped 10% and the entire crypto market is reeling from a bombshell that dropped last night. The Senate just revised the Clarity Act to ban stablecoin yield. The banks won. Jamie Dimon won. The fight we've been covering for 2 weeks between the White House and Wall Street over whether crypto platforms can pay interest on stablecoin holdings just tilted decisively in the bank's favor. And the implications for XRP and Ripple's Rust stablecoin are massive, but not in the way you might think. Before I continue, this is not financial advice. I'm sharing publicly available information for educational purposes only. Always do your own research and consult a qualified professional. Let me explain exactly what happened because the details matter enormously. Senators Tom Tillis and Angela Also Brooks reached an agreement with the White House on a revised draft of the Clarity Act. The new language prohibits crypto platforms from offering yield directly or indirectly on stablecoin holdings. The draft bans anything economically or functionally equivalent to interest on stable coins. This kills the business model that Coinbase and other platforms have been building around earning yield on USDC holdings. Circle's stock dropped from 126 to 98, its worst single-day crash since June 2025, wiping out roughly $4.66 billion in market value. Now, here's what most people are missing. This is the exact outcome that the banks were fighting for. Remember what I told you 2 weeks ago when Trump attacked the banks on Truth Social? The single issue holding up the Clarity Act was stablecoin yield. J.P. Morgan, Bank of America, and Wells Fargo argued that if crypto platforms pay 4 to 5% on stablecoin deposits while banks pay 0.5%, deposits would drain from the banking system. Jamie Dimon called it a need for a level playing field. The banks lobbied hard to block stablecoin yield and they won. The revised draft gives them exactly what they wanted. No yield on stable coins. Deposits stay in banks. The so-called level playing field is preserved. The crypto industry, represented by Coinbase CEO Brian Armstrong and Circle, lost this particular battle. But here's the critical twist that I think changes the entire calculus for XRP. The Clarity Act is now much more likely to pass. The stablecoin yield provision was the single biggest obstacle to passage. The banks were blocking the entire bill over this one issue. By resolving it in the bank's favor, the Senate removed the primary objection that was preventing the bill from advancing. The Clarity Act includes XRP's permanent commodity classification. It includes the regulatory framework that institutional investors need to allocate. It includes everything that the XRP ecosystem has been waiting for. And the one obstacle that was blocking it just got resolved. This is a trade-off. The crypto industry lost stablecoin yield, but XRP could gain permanent commodity classification under federal law. That's not a bad trade for XRP holders. Now, let me talk about what this means for Ripple's Royal USD specifically because the analysis from BN Crypto today was illuminating. Circle earned 96% of its revenue from interest on USDC reserves. Those reserves sit in U.S. Treasury bills. The Clarity Act doesn't touch that income stream. It bans platforms from passing yield to users. Circle still collects every dollar of reserve interest. The same logic applies to Rust. Ripple earns income on the reserves backing Rust. The stablecoin yield ban prevents them from sharing that income with holders, but it also eliminates pressure to share it. Before the ban, there was growing expectation that stablecoin issuers would need to offer yield to compete. That competition would have compressed margins. The ban removes that competitive pressure entirely. So for stablecoin issuers, the yield ban actually protects their business model even though the stock market is treating it as bearish. The market sold Circle because it assumed the yield feature would drive USDC adoption. But Circle's actual revenue, the interest on reserves, is untouched. The initial reaction is panic. The longer-term analysis suggests this might actually be a bear trap. Now, let me connect this to the March 27th deadline because everything converges in 48 hours. The Clarity Act revision removes the biggest obstacle to passage. Senator Loomis targeted markup for the second half of April. Galaxy Digital warned that the bill needs to clear committee by the end of April or it dies for 2026. The yield compromise makes the April markup dramatically more likely because the banks no longer have a reason to block it. If the Clarity Act passes committee in April, XRP's commodity classification becomes permanent federal law. Combined with the March 27 ETF approvals, which would expand institutional access, the 1-2 punch of ETF expansion plus permanent commodity classification could trigger the repricing that 28 catalysts over the past 2 weeks have been building toward. XRP is trading at a 141 this morning, up 3.3%. It's showing relative strength, while Circle and Coinbase are getting destroyed. Why? Because the market is beginning to recognize that XRP benefits from the Clarity Act passing and the yield ban makes passage more likely. XRP is also potentially about to close March in positive territory for the first time in 6 months. The 5-month losing streak could end this week if XRP holds above a 137 through Sunday. The technical picture supports this. XRP started a fresh increase above a 142. There's a bullish trend line forming with support at $140 on the hourly chart. Resistance sits at $14,250 and then $144. A break above $144 opens the path to $14,650, which was the high from this week's bounce. And the broader analyst picture from 247 Wall Street's 5 analyst roundup is worth understanding. Standard Chartered sees 280 by year-end and 28 by 2030. Nick Ruck from LVRG Research noted XRP held up better than most altcoins during the 2026 sell-off, suggesting long-term holders aren't selling. At $10, XRP's market cap would be $610 billion, roughly where Ethereum peaked. Getting there needs ETF inflows past $5 billion, the Clarity Act to pass, and Bitcoin recovering toward new highs. The key insight from their analysis is this. The biggest signal to watch isn't Ripple's next deal, but what percentage of XRP ETF money comes from institutions. Right now, only 16% of XRP ETF assets are institutional. Bitcoin spot ETFs flipped that ratio within their first year, and BTC went from 40,000 to 126,000 during that stretch. If XRP ETFs see a similar shift, the $5 to $15 range by 2030 is well within reach. And the Clarity Act passing is the single biggest catalyst for that institutional shift to begin. 2 days, March 27th, ETF deadline, options expiry. And now, with the stablecoin yield compromise removing the biggest obstacle to the Clarity Act, the regulatory path has never been clearer. The banks won the yield fight, but by winning they may have accidentally cleared the path for the biggest XRP catalyst of all. Sometimes the opponent's victory is your setup. Macro storms pass. Infrastructure lasts. Smash that like button. Drop a comment telling me whether you think the stablecoin yield ban is bullish or bearish for XRP. This is a genuinely debatable question and I want to hear from both sides. Subscribe and hit the bell because March 27th is 48 hours away and I'll be covering the ETF decision and the Clarity Act developments in real time. Share this with someone who saw the Circle crash and panicked. Show them the other side of the story. I'll see you in the next one. But I'm not done. There are 4 more things I need to cover because what happened yesterday is the most significant political development for XRP since Trump attacked the banks on Truth Social. And I want you to understand every dimension of it before March 27th. First, the political chess game behind this compromise is fascinating. Trump publicly told the banks to back off and let the Clarity Act pass. The banks refused. They held the bill hostage over stablecoin yield for 3 months. The White House set a March 1st deadline that was missed, then a March 10th deadline, also missed. The battle became so public that Jamie Dimon confronted Brian Armstrong at Davos. Former CFTC Chair Jim Carlo said the banks need the bill more than crypto does. And Trump warned on Truth Social that the crypto agenda would go to China if the banks didn't cooperate. The compromise that emerged is classic political deal-making. The banks got what they wanted on stablecoin yield. The crypto industry gets what it wants on market structure and commodity classification. Neither side got everything, but both sides got enough to move forward. And for XRP, the commodity classification side of that deal is infinitely more valuable than the stablecoin yield side. XRP was never a yield-bearing stablecoin. Its value comes from being a bridge currency for cross-border payments. The yield ban doesn't affect XRP's use case at all, but the commodity classification affects it profoundly. Second, let me analyze what the yield ban means for the competitive landscape between Rust and USDC. Before the ban, Circle's USDC had a potential advantage because platforms could attract users by offering yield on USDC holdings. That made USDC sticky. Users held it not just for transactions, but for passive income. The yield ban eliminates that stickiness. Now USDC and Rust compete purely on utility integration and ecosystem support, and on those dimensions Rust has significant advantages within the Ripple ecosystem. Rust is native to the XRP ledger. It's integrated with Ripple's payment corridors. It's backed by Ripple's banking relationships, and it's part of the same institutional infrastructure that Goldman Sachs, Deutsche Bank, and MasterCard are building on. The yield ban levels the competitive playing field in a way that actually favors Rust's utility-focused design. Circle built its moat on yield. Remove the moat and the competition shifts to infrastructure and partnerships where Ripple has the advantage. Third, let me talk about the significance of XRP potentially ending its 5-month losing streak, because market psychology matters as much as fundamentals. XRP has posted negative monthly returns every single month since October 2025. January down 10.6%. February down 16.2%. 5 consecutive months of losses. That streak could end this week if XRP holds above 137 through the end of March. Why does this matter? Because streak-breaking months change narrative. When an asset has been falling for 5 months straight, the dominant narrative is decline. Investors who check their portfolios monthly see red. Media coverage emphasizes the downtrend. Sentiment compounds negatively. But the moment the streak breaks, the narrative shifts. A green March monthly candle, even if it's modest, tells the market that the downtrend may be exhausting. It gives analysts a reason to write optimistic articles instead of bearish ones. It gives retail investors psychological permission to buy instead of sell. And the timing is perfect. March would be the month that included the SEC commodity classification, the Evernorth Nasdaq filing, the MasterCard partnership, the controller opening the Fed to Ripple, and potentially the March 27th ETF approvals. A positive monthly close would associate all of those catalysts with a green candle in the minds of investors reviewing their portfolios. Fourth, the Elliott Wave thesis from yesterday gains additional significance in light of the Clarity Act compromise. Dark Defender analysis shows Wave 4 is complete and Wave 5 targets 850. Elliott Wave 5 typically launches when a catalyst arrives that confirms the trend has reversed. The Clarity Act passing committee could be that catalyst, and the stablecoin yield compromise just made passage dramatically more likely. Think about the sequence. March 27th brings ETF approvals. Late April brings the Clarity Act markup. If both catalysts land in sequence, the Elliott Wave 5 impulse could begin its run. Wave 5 in the previous XRP cycle took the price from $38 to $3.40. If Wave 5 from current levels follows a similar magnitude, the 850 target that Dark Defender outlined becomes the base case, not the bull case. And the broader analyst consensus supports this trajectory even without Elliott Wave analysis. Standard Chartered sees 280 near-term as the conservative floor with 28 by 2030. The Miley Fool's velocity model gives $20. Coinedia's optimistic scenario gives 641 by year-end. Multiple analysts see the $3 to $8 range as achievable if the Clarity Act passes and Bitcoin cooperates. Now, let me give you the complete 48-hour preview, because we're entering the most important 2 days in XRP's recent history, Wednesday, March 25th. That's today. The market is processing the Clarity Act revision and the Circle crash. XRP is showing relative strength at a 141 while crypto stocks are getting hammered. Watch whether XRP holds above a 140 through today's session. If it does, the bullish trend line on the hourly chart remains intact and the setup going into March 27th is strong, Thursday, March 26th. This is the last full trading day before the deadline. Expect volatility as traders position for the March 27th outcome. Options market makers will be actively hedging as the $14.6 million open interest at the $140 strike approaches expiry. Volume should increase. Spreads may widen. This is not a day for leverage. Friday, March 27th, the SEC's final deadline on remaining XRP ETF applications, the options expiry, and potentially the day that institutional capital gets the green light to enter XRP at scale. If approvals land, watch for an immediate spike followed by profit-taking, then sustained inflows over the following weeks. If approvals are delayed, watch the $830 support level. The floor at a 127 with 443 million XRP in cost basis should hold unless Bitcoin breaks below 65,000 simultaneously. Regardless of what happens on March 27th, the Clarity Act compromise that dropped yesterday is arguably more important for XRP's long-term trajectory than any single-day ETF decision. ETF approvals expand access. The Clarity Act creates permanence. And the yield ban just removed the last obstacle to permanence. The banks won the yield fight. XRP holders might win the war. Macro storms pass. Infrastructure lasts. Smash that like button. Drop a comment telling me whether you think the stablecoin yield ban is bullish or bearish for XRP. This is a genuinely debatable question and I want to hear from both sides. Subscribe and hit the bell because March 27th is 48 hours away and I'll be covering the ETF decision and the Clarity Act developments in real time. Share this with someone who saw the circle crash and panicked. Show them the other side of the story.